I don't hear you. I'm sorry. Let me see.
I think they're on mute.
Now I hear you. Now I hear, yeah, Eileen, I hear you.
Yeah, because I think they're on mute.
They're on mute?
Yeah, I think so. I don't think they turned the meeting on yet.
All right, Chesney, well, you're on mute right now, I think. We heard you a second.
Okay, I just want to check. Dave, can you hear us?
Now I can.
Perfect. Okay, I'd like to call to order the pension board meeting on Wednesday, February 14th, and seek approval of the minutes from January 10th.
Motion to approve.
Well, there was one change only because I never do motions and for adjournment. Rich, you motion to adjourn. Okay, all in favor, aye, okay, perfect. Any other changes to the minutes? Perfect.
One little detail, my name was misspelled again, but not a big deal. It's P-A in there instead of P-R-A-M-E-R.
No, and actually, and I was not here.
Right,
I can't make any other comments on the minutes, but I wasn't here.
right.
I do know that.
Very spirit. Okay. Motion to accept the minutes as adjusted. All in favor, aye. You're not gonna vote. Opposed, no, thank you very much. Public comment, is there any public comment? No, as usual, there are no pension applications yet again this year. So now we're gonna go to Pantheon Private Equity.
Great. So as you know, and for Bob, Pantheon's private equity manager for the pension. Most of the commitments at this point are very old. The last commitment was in 2014. So almost all of the assets left in private equity are in the 2014 fund. Some of these older vintages are very old, as we were talking about a minute ago, commitments in the early 2000s. So I think from Callan's standpoint, we want to get an update on when those funds are going to come to a close. And we asked Pantheon to provide an update on performance for the 2014 fund, which has done very well so far and continues to appreciate.
But one of the reasons why we haven't been putting money in private equity is because we're in a negative draw and liquidity is important. So that is why we made that decision to not really put any more money in private equity. Okay.
Any questions before I grab Pantheon, guys?
No.
Okay.
I didn't meet you.
Bob Raleigh.
Bob, you nice to meet you.
When I was coming in, they were downstairs and the guy was actually asking for IDs. And I said, yeah, I'm going, whoa.
I just walked by and nobody ever said a word.
Yeah. And so I just said, you guys with Pantheon, I go, yeah, come on.
How are you doing?
You guys? These two? Yeah. Perfect. Thanks. Does anybody need presentation?
It was all that.
Have it?
I'm talking at like $100.
Yeah, of course. Does anyone else need a hard copy?
Yeah, I'm good. I'm good. Thank you.
Good to go?
Floor's yours.
All right. Appreciate everybody's time. Thank you for letting us come in and give you an update on your commitments with Pantheon. Maybe I've met most of you, I think, or a lot of you virtually over the last couple of years, but Jeff Wright, I'm a managing director on our US Investor Relations team. Actually, technically based out of New York, but I work from my home in Pittsburgh. I've been with Pantheon almost 6 years, but in private markets for about 20, which is sort of painful to say a little bit, but yeah, so pleasure to meet all of you.
On the screen as well.
And I'll give just a quick introduction. I don't think I've met any of you before. My name is Jack Opperman. I've been with Pantheon for about 5 years now. I originated out of our London office, as you might be able to tell with the accent. I worked on our product strategy team for 3 years in London, and then moved to our New York office to join Jeff on our investor relations side. I've been in the States for 2 years now, and I love it.
Good.
Welcome.
So-
Thank you.
What I thought we could do today, if it's amenable to everybody, is give you a quick update on the firm and the personnel, an update on the market, a backdrop of what we're seeing and the opportunities out there, and then a portfolio review for Norwalk, focusing on your most recent commitments, USA Select 2014, as well as PUSA, PUSA 8, but we can cover the other prior investments as well.
I
And
think
would,
one of the questions,
Yeah.
you know, some of these prior commitments are very old at this point.
Yeah.
And in terms of winding down, you know, an expectation for that would be helpful.
yeah, maybe we can address that right now. So maybe going in reverse order, PUSA 4, that's a 2000 vintage that's currently in liquidation. The net asset value is quite close to zero. So, and maybe stepping back a second, the PUSA 4, 6, 7, and then the PGSF 3A and Puro 5A funds are all in wind down liquidation mode. We're actively managing the tail end there. We would expect over the next 18 to 24 months that those will completely roll off the program. USA Select 14 and PUSA 8 are going to take a little bit more time. We can talk about why that is, but we would expect by and large that those would be rolled off the program.
When things roll off, that basically means there's an IPO or what?
The-
Buyout by somebody else?
The fund liquidates all its existing investments,
Okay.
and then it ceases to exist. It effectively goes into wind up, and it's closed once all the assets are out.
But the assets are out either
They-
IPOs or somebody bought them.
That's
or
correct.
whatever.
Yeah, the exit activity would be either another financial sponsor, a strategic buyer, like a corporate, or the IPO. So M&A or IPO markets.
Historically, what's the cost? What's the discount?
The discount,
I mean, if we have like $500,000 in, what do you think we're gonna get out of it?
well, so you mean like of residual value left in the
Yes.
fund? We would hope at least that much, if not more. There's enough in the portfolio that, and I don't know, all the underlying portfolio companies are marked currently, but as they're exited, typically our general partners in general tend to hold value things conservatively. So we would expect some marginal upside to the existing NAV or net asset value or multiple in place.
Will you sell to secondaries funds?
Yes. Yep. We've actively participated in the secondary market for as long as I've been here. We do kind of an annual review, and then make a recommendation. We'll talk about some of that because PUSA 8, one of the more recent Norwalk funds, we are doing a partial sell there. So we can talk about that a little bit as much as we can because it's in process. But
Are you on both sides of the secondary markets, buy and sell? Or?
yeah, but we don't buy and sell our own funds, just to be clear. And we don't typically buy tail end funds, as it were. Anyways, our strategy is more centered on kind of that fourth or fifth year of where unfunded is very little. We have good look through into the underlying portfolios, and we know what we're underwriting, right? That's kind of the benefit of secondaries is you're getting a look after the capital's been in place.
In terms of the market and the exits themselves,
Yeah.
have you been seeing a longer timeframe and or a discount? And not in the sense that, you know, again, we might still come ahead, but relative to what maybe we could have expected, you know, pricing levels prior to, say, 18, 24 months ago.
Yeah, so I think holding periods have certainly increased. I think that's been a trend that's occurring over kind of the last decade and a half, if not a little bit longer, which you've seen a proliferation of these continuation vehicles. So GP, general partners taking some of their portfolio companies, single asset, maybe a couple of assets, putting them into a special purpose vehicle, and then resetting all the economics, including funding those. So they're holding on to portfolio companies longer. The IPO markets have been closed for sort of the last 18 months.
Right.
We're starting to see M&A pick up a little bit. And even considerations around IPOs. There's a couple of, so Parthenon, who's a GP in your portfolio, is getting ready to approach the public markets with one of their portfolio companies. And we're seeing some M&A activity. Veritas, I think, was the other one. Largely, you know, these are both healthcare related transactions, healthcare tech services, so not tied to government reimbursement. But we're starting to see activity certainly pick up, and would expect that to continue as the economic indicators sort of tell us that things are starting to look a little bit better. I think, you know, the one thing that's, you know, I think not going to happen going forward is these GPs just making money off of 0%. Literally, you know, the leverage was super cheap, right? So it does. This is where the rubber meets the road for us. This is where I think we tend to pride ourselves, is we don't diligence and commit to financial engineering firms. We commit to buy and build sector specialists or geographic specialists that they have a reason to exist. They're not just, you know, what do they call that? Excel wizards.
Okay.
Maybe reset a little bit. We can give you a brief update on the firm. So I think the headline here is not a lot has changed in the last year since we've been in front of you, which is a good thing. You like to see consistency, not only with the firm, but staffing and personnel. We continue to look for opportunities to build out adjacent strategies to our core portfolio. So as it stands now, Pantheon is about $95 billion in assets under management and advisement. We have a private equity group that consists of primary funds. So folks are in co-investments and secondaries. We have an infrastructure group that does secondaries and co-investment, a little bit of primaries, but it's not the core business. A private credit group that focuses on secondaries that came into inception, dedicated back in 2018, 2019. And then our most recent strategy, we took a couple of folks out of GI Partners, actually up here in Greenwich, who are running a real estate program there. And they are, we are getting ready to launch our second kind of real estate secondaries fund. So the firm as it stands now is over 450 people, about 140 investment professionals dedicated to those strategies, right? And all sort of working together. It's our sourcing and origination engine in many ways when we look at some of our strategies. Only new office, I think we're up to 12 now. We opened a Singapore office earlier or late last year. So many of our folks in Hong Kong have moved down to that office. I don't have to tell you, business continuity was one of the reasons we did that. I think many of our peers have also followed suit or done it before us. And Singapore City continues to be a burgeoning hub for finance and capital markets in Southeast Asia. So we felt like that was strategically a good place to be, both from an investment perspective and a client service perspective.
Portfolio, the companies, the underlying companies that we've been invested in through these funds, are they US based?
Yes, sir. It's
Global.
90, we can get, it's 90+% in,
96.
yeah, in the most recent. Now you have, you'll see the Puro 5A fund. That's European. So there is some European exposure there, but it's very little in terms of the overall portfolio landscape. Maybe turning to slide 5 real quickly. This is our global investment team. It sort of includes in graphic or in picture all those folks. Our international investment committee is sort of the senior most leadership of the firm that is constructed of folks throughout the business to give us kind of a holistic view. I note that Catherine Leaf and Jeff Miller at the top there, who are partners, were promoted to the co-heads of the business. So effectively co-CIOs. Jeff is also our global head of private equity, and Catherine's also our global head of real assets. And then from a regional perspective, Jamie Hayford, Imogen Richards, and Jack Farr have been added to their investment committees. And that's just a recognition of frankly, their performance and growing importance to the firm over time. Slide 6 is why we're here. We wouldn't exist without the folks on this page, without the folks sitting in front of us right now. We have a very diversified group of investors, from public plans to healthcare organizations, endowments and foundations, trusts, private wealth. And we think it's pretty well diversified by channel, by geography, and we continue to kind of deliberately add to that where there's a good fit with somebody who wants to partner with us. And then the final page of this section is just a private equity platform overview. We talked a lot about this. You know, it's the bread and butter of our business, and you know, really the foundation of the organization. It will continue to be very important to us. But we are investing and expanding into other asset classes and have done so for the last 15 to 20 years across infrastructure, credit, and real estate. I'll hand it over to Jack for a quick market backdrop there.
Sure, thanks, Jeff. And I think we touched on it briefly when we started talking, but I'll take it one step back and just look at private equity fundraising as a whole. So it's continued to grow as an asset class year over year. If you look at the last 10 years, it's grown from 230 billion odd to now $500 billion a year in annual fundraising. And what does that mean for the market as a whole? If you look at slide 10, what this looks at is effectively NAV in private equity, NAV and unspent money. And this is again growing year on year, up to about 4.7 trillion in AUM, assets under management, for private equity managers. And we expect that, and Preqin, a sort of a market research company, expects that to almost double in the next 4 or 5 years.
One of the things is we're satisfied with your performance.
Mm-hmm.
One of the realities is we have like the 14th fund is now 10 years old.
Mm-hmm.
And I think when we originally put the money in some of these funds, we were told it was going to be 5 to 7 years.
Mm-hmm.
We are in a negative draw pension plan, so therefore liquidity is really critical to us. So regardless of whether, people are doubling money in private equity, that's really not our care right now. We just want to see what performance, I believe. So if we just kind of skip all that,
Yeah.
and just keep going.
Absolutely. And maybe touching, that's a good point, touching on USA Select 14's performance, if we go to the next section, and specifically addressing your questions around the position of the plan. We're not expecting any further capital calls the investment periods for most of those funds are concluding this year. But we're in a pretty good cash positive position within the fund. That any capital calls for fees, expenses, or follow-on investments will just be netted against those distributions. So I would not anticipate any further capital call activity, reaching the office, so to speak. The administrative burden will not be there.
Thank you.
Yeah, no problem. And we think we're gonna get somewhere near 90% called on that capital. We talked about realizations. I think those will continue as market conditions improve. Exit activity and exit windows will start. We're starting to, we're going to our annual meetings. We're hearing these general partners. They're starting to become more positive on the exit markets and ways to extract liquidity. Everybody wants distributions and liquidity right now, including us. So we're working really hard for you guys and all of our clients to make sure that the alignment of interest is there across the board. Overall, CUSA or USA Select 14, bulk of the commitments were made in the 2015, 2016 vintage years. From performance standpoint, we can look at it multiple IRR. We've also looked at it from a public markets equivalent. So what we're saying here is, if you took the dollars that you were putting into these private funds and you put them into the public index, say the S&P 500, how would that index perform over time relative to the commitment you made? And we have outperformance of about 500 basis points, about 5%. So your USA Select's doing about a 16% net IRR, and the S&P over that same time frame is at about 11.3. So
Those annual earnings?
they are, no, it's a dollar weighted. So every time we call capital from you, that would be like you putting money into the S&P index.
Yeah,
And we
I
all
get
know,
that
yeah,
part.
yeah. And we consider that, we're pretty proud of that, considering where the S&P has gone, certainly over the last 6 months. So it's important for us to deliver the kind of 300 to 500 basis points of outperformance over the top end of the spectrum there.
When you look at your other funds, the other ones that we held on to, the net IRR is actually a little lower than that one there, right? The 10%, 1.9, 6.6. So how do you explain that versus where we are today with 16% for the one that's kind of outstanding and kind of in mid-flight?
Yeah, no, good question. So I think it's a bit of an academic exercise in making sure that you're allocating to all the vintage years, because there's outperformance there. But acknowledging that private equity, private markets isn't where the city wants to spend its time going forward. We certainly acknowledge, particularly PGSF 3A, the 2006, that is a disappointing fund for us. We invested it right around the time, almost finished investing it right around the time that the GFC hit, the great financial crisis, and we took it on the chin there. I think lessons learned from that, we've been better at fund management, how we manage our capital calls and distribution activities. And I think, the scars have proven to be a good experience for the investment teams, many of whom are still on that team. As a nice reminder that we always have to have our most diligent cap on when we're looking at these opportunities. So yes, we'd certainly acknowledge that 06 vintage, but in general, the IRR is going to come down over time. These are certainly long in the tooth funds. What we would point to is the IRR is certainly nice. We want a nice, healthy IRR for you guys, but at the end of the day, what do they say? You can't eat IRR. So the multiple of money that we're returning to you is also a very important measure of that performance as well.
Was there a particular area within the 06 vintage where, you know, the fund got tripped up on, or?
Yeah, so that was the Fund 1, 2, and 3. That's a secondaries fund that you're invested in. So Fund 1, 2, and 3 in that strategy were a legacy strategy to us. So we sat down after Fund 3 and said, mea culpa, we have to figure this out. That we were doing management buyouts, we were doing venture secondaries, frankly, probably things we shouldn't have been doing. From looking back on it, where is our expertise? Where are we specialists? It's in the small mid-market buyout space, growth equity, positive cash flowing growth equity, not in negative EBITDA still or net gains. But it was a little bit of that. There was some energy in there as well that was timed incorrectly, and so we took a step back and did a diagnostic of that strategy and made a shift for Fund 4. And that fund now is on, I think we're raising, we just closed Fund 7 last year. We'll be out raising Fund 6 later this year. And it follows that same strategy. We have a couple of other slides in here, kind of performance drivers over the last year. We've distributed, an additional almost 3% back, netted against calls. So it's about a 2% distribution back. Again, we expect that distribution activity to continue to pick up, and subsequent calls to go down. I didn't know if there were, I think you wanted to cover Puce 8 too, right? Or 7?
I think
we concentrate on the 2014 fund
2014.
since,
Okay.
95% of the
Yeah.
assets for Norwalk are still there, and talk about the harvest period and kind of what you're seeing from that fund.
so. I mean, I can touch on a couple of things with that fund, and I'm sure that Jeff will jump in and add to this. But I can see that some of you are on slide 17 already, which looks at the top exposures in that fund, in that USA Select 2014 fund. So the first thing I would say is that the GPs or the firms that we're invested in here are all core managers to Pantheon, people we like to partner with, people we like to invest with, people that we're also close to. So we have a strong relationship with these managers. There are a couple of realizations that I can speak about, or upcoming exits that you will see coming back into your portfolio over the next 3 to 6 months. So there are two managers in here that I want to point out, and we've already touched on them. It's Veritas and Parthenon. So both of those have upcoming exits, either to other private equity players, or one of them is potentially exploring an IPO. The two assets that they are, or the two underlying companies in those funds, are the largest companies in each fund respectively. So you should see two nice realizations coming up. And one thing that I would touch on, and the way that the market has changed, and when we invested these funds, so the majority of capital in USA 2014 was invested in like 2014, 2015, 2016 vintage funds. Those funds are now, should be well past their investment period. Those GPs are now looking to realize the underlying companies. There may have been a slowdown in exits and distributions over the last couple of years. That's really because of market volatility and COVID. Jeff already touched on it. We're seeing the market open up. We're talking to our GPs on a daily basis, and they're giving sort of positive indications that they're expecting more and more realizations to continue. So there's a chart on the slide above 16 that looks at sort of distributions and paid in quarter over quarter. You can see for the last 8 quarters or so that distributions have outstripped capital calls for the fund. But what I would say is you'll start to see that even more. You will see the light, I don't know what color, light sort of green color that is, continue to outstrip and to continue to sort of evolve and send more cash back with that fund. There are a couple of later vintages. So there's a 2018 fund in there, Onyx Partners, that's coming to the end of its investment period. So they're not going to continue to invest. the sort of the deals they've done back in 2018, they would start to be looking to exit those companies, but there may be a couple of companies that sit towards the tail end that may take a little bit longer to realize. But as Jeff already touched on, we will actively manage this portfolio and try and manage liquidity and push our underlying GPs to sort of think about realizations, whether that's us helping them do it or with sort of trade sales to other private equity players. I'll pause there. I don't know if Jeff has anything to add.
It's pretty fulsome.
Any questions?
We're looking 18-month window roughly for capital back.
Yeah, I think you'll start to see capital coming back in the next sort of 3 to 6 months. There'll be some exit activity here. It'll be a drip feed.
Yeah.
But I think it's going to continue. We think it's going to continue. There's a lot of the investment team feel really good about a lot of the underlying portfolio company inventory that's in USA Select. These are high quality companies, so it's just a matter of patience and timing here, waiting for the IPO market to open back up and M&A activity to be a little healthier.
In your opinion, what's the biggest driver of the IPO market activity? Interest rates, general economic activity, stock prices? All of these-
Certainly the health of the stock market, I think, is a big consideration. Depending on the type of company you are, interest rates would certainly play in there, right? Tech's a little more sensitive to the interest rate environment right now. But largely it's really investor receptivity to new investments, right? And you see that on the private side too. Many of our clients are saying, we're re-upping with our existing managers. We're not doing any new managers. So in the same way, that portfolio manager that does small cap value at T. Rowe Price is saying, I've got my 36 underlying stocks that I'm holding right now. I feel really good about. I don't need to add new exposure. And so it's a matter of behavioral finance a little bit. Is there a question on the
No.
line? Oh.
Any questions, Dave?
No, I don't. I'm fine.
Anybody else? Anything else?
Good.
Thank you very much.
Fantastic. Thank you guys for your time.
Thank you.
Really
Thank you.
appreciate it.
Thanks for
Come
making
all
the
the way
trip.
from
Yeah.
Chicago to come here.
Pittsburgh.
Well, I was in Chicago earlier today.
Remember, I talked to him.
Yeah,
Thank you guys for making the
Thank
trip.
it's important to us. So,
So Charles.
thank you. Pleasure.
Take care.
Yeah, just take notes.
Thank you very much. Nice to see you.
Appreciate your time.
Thank you. Nice to meet you. Thank you.
Hold on to it.
You don't know how long he's been working on that.
Yeah. Thank you. Nice to meet you.
Thanks, guys.
Thank you.
Kind of one thing to be fair, as a chair here, is that when we put money into private equity in 2014, none of you were on the board, and we really, Dave's brother especially, he and I were really not big on the private equity because we were concerned about, again, we had money from 2001. And we had the guy in here saying, oh, 5 to 7 years. And, now 23 years later, so, but I don't know whether the consensus of this board has changed. One of the things is because we do have liquidity concerns. And I remember in 08, 09, when people were getting capital calls and the market was going down and there was a lot of blood. We never wanted that to happen. We didn't want to have to be, if we put more money into private equity, we wouldn't want to have to be getting capital calls at a time when.
When you have to liquidate it.
when
Or-
we have to
or
liquidate.
sell.
Right.
Yeah.
And so I don't know whether. So we've had a plan basically to not add money to private equity. And I don't know if anybody would be,
Over the long haul, private equity has outperformed equity, right? So by 400, 500 basis points roughly. So, I mean, that's the offset to the liquidity concern is there's a little more juice here most of the time.
There is, and I think one of the hard parts with doing that is to really have a successful private equity portfolio, you have to commit money every year.
right,
So that
Rather
if
go
you
through
invest in the
cycles,
2006
Right.
vintage, it's not gonna take everything from your portfolio. It's just a small part. That's
Yeah.
one fund. And you can see the 2014 vintage has done extremely well.
Mhm.
But if there's not consensus, in terms of committing to that pacing, then we could totally understand and support the board and in their thinking. I think the other thing is the discount rate for the pension fund has come down probably from over 8% when these commitments were made to 6.5%.
Mhm.
And, where our capital market projections are today, we don't think you need private equity to
Yeah.
achieve 6.5%.
In other words, if you want to benefit from the long-term trends, you have to invest on a long-term
Correct.
basis year after year. And yeah, so,
And the plan's well funded too. I think a lot of our public pension clients that have large allocations to private equity are not well funded, higher discount rates, and they're trying to improve that funded status by juicing their returns,
Yeah.
which is a very hard game to play.
And the premium that
Are they getting better returns than we're getting? Or are they getting, when we look at this right now, on that page, page 13, I mean, our total return was 8.8%.
So there's one thing I was gonna say, is that premium, that is in the direct space, so fund of funds, you're gonna get a haircut right off the bat with the extra
2% or so.
whatever it is, even if it's 1%, it's an additional layer there of that fee component, which is the biggest hindrance to performance, for any asset class. And then I just lost my second train of thought. Oh, it's just within private equity, manager selection is everything. Like top quartile, phenomenal, but like there's such a drop off to the, even like the second quartile and so onwards, right, third, fourth. So you really have to be in with those top direct funds, have access and be able to commit at sizable, like at this level, it doesn't necessarily make sense. You're not gonna get it.
We're not gonna get calls for our 20 million bucks.
Yeah. But I mean, I think, supporting your original thought is just like, and I think Britt's with me here, like, it just doesn't seem like,
It's never gonna move our
why
needle
do we
that
need
much.
to, right, chase that?
well, the other thing is, Dave, if you ever voted for private equity, your brother, who used to be on the board, who is the most opposed to private equity of all, he would really disown you. He
Yeah,
just-
I understand. He's shared his perspective before.
Yeah. Okay,
Yeah, so I think we're in agreement between the fund to fund point, that whacks the premium in half almost. And then it's never gonna be a big piece of our portfolio anyway.
Right.
It's not gonna move our needle.
Right.
And then you have the liquidity issue, so, yeah, I think there's an agreement on it.
with that, you wanna go to performance review?
Sure. Kevin, you wanna?
Yeah, I'm just gonna take just like a minute to talk about the markets. So we're thinking about December here, just to make sure we're all on the same page. But pretty sharp rally. I mean, listen, the last like 70 days have been nothing but straight up except for like yesterday perhaps, but then we captured it all right back today, it seems like.
Half of it.
Half of it, right? So, and a lot of that was, kind of on the heels of, maybe we'll call it a Fed pivot. Jerome Powell seemed to be pretty dovish, with some comments at the reserve meeting in December. Pretty, the interest rate moves themselves are pretty unprecedented in terms of like yields dropping lower across the curve. So we had the 10 and the 30-year fall by 48 basis points. Saw credit spreads tighten, and IG debt narrowed by 5 basis points, high yield spreads lower by 47 basis points. So again, pretty substantial moves there. And really, as it's kind of been the story or what was most of the story for 2023 is stocks reacted really sharply to a lot of that news. And so we saw US equities rise 4.5%, using the S&P 5 index as a measure. Global equities actually outperformed US equities. So the MSCI ACWI was up 5.2%. Just kind of a reminder of why we own abroad. EM stocks, they were positive, but they did underperform both the US and the developed international. They were up just shy of 4%, 2.9. And then, on the small cap side of things, so bear in mind, small caps are always much more rate sensitive. And we saw what was really pretty remarkable small cap performance in December. They were up 10.7%. That's the Russell 2500 index. So kind of small mid cap area. I think one of the interesting things that has happened now is where future expectations lie. So the Fed, they have this thing called the dot plot, which is really just a survey of the board members' future expectations. They had a median expectation of 3 cuts in 2024. The markets, and this is using the Fed Fund futures, they're pricing in 6 cuts during that same period. I bring it up because it's sort of irrespective of the outcome. I think the point is that whatever happens, there's going to be a repricing at some point, across asset classes. The markets have already sort of baked in a soft landing. So what that means is like any sign of weakness, we're going to get a ton of volatility. So again, it doesn't really matter if we're the 3 or the 6 or whatever, but I think it could be an interesting ride in, the next 12 months here. Could be very wrong though too, and we could just get another gangbuster year, so.
Yeah, and even within the Fed's dot plot of the member expectations, there is no consensus. It is
Big scatter diagram.
a lot of different opinions.
Yeah.
But I think, in December, the market reacted in the expectation of rate cuts in 24, and we saw risk assets really take off. And one thing I would highlight just in the fourth quarter, the ag was up 6.8%, which is the largest quarterly return since 1989. So it kind of shows you the rate changes that we saw. If we have the flash open, I'll start on the asset distribution page. So assets, about 501.7 million. We saw a little over 22 million in unrealized investment returns. In December, we raised 10 million to pay benefits. So you can see even taking that money out of the BlackRock Russell 1000, US equity remains overweight by about 1%. Global equity long short remains steady, just over 4%. We are planning to bring an asset allocation review to the next meeting to discuss the expectations in terms of the total fund return based on the current policy and reallocating 4% from global equity long short that will be removed since Blackstone has been terminated. Private equity slightly overweight. Again, that 3% is really an aspirational target. given the wind down, we saw a small distribution of 60,000 from the 2014 fund. Slight underweight remains to fixed income and slight overweights to absolute return and real assets. The next 2 pages, we show performance. A few highlights. LSV, your small cap value manager, continues to do extremely well. You see fiscal year to date up 13.5%. Now they're above their benchmark over the 3, 5, and 7-year periods, which is great. They had a tough time there about 3, 4 years ago and have really bounced back well. You'll see principal dynamic growth underperformed fiscal year to date. In that fourth quarter that Kevin was referencing, small cap growth stocks were up 12.5%. And a lot of that rally was in weaker sales growth companies. So, principal underperformed. They returned about 5.6% during the quarter, driving their 2023 return to well below the benchmark. I think the small cap universe has been an interesting area where we've seen, a lot of differentiated return patterns and, a lot of managers struggling. Not that that's an excuse for principal. I think, we should continue to keep an eye on them, potentially have them in again in 2023. In terms of the international managers, Silchester has done a great job continuing their steady performance. Walter Scott actually outperformed in the fourth quarter, up over 14% versus 10% for the EFA index. Most of their relative underperformance versus EFA was due to the first quarter that Norwalk was invested in with them, where their quality bias really got hurt given the market dynamics. BlackRock continues to do fine. You can see some slight outperformance there fiscal year to date, and ABS has largely done a nice job over the last year. You can see returning over 9%, outpacing the HFRI index. And then on the last page, your fixed income managers have done a nice job. See both MetWest and Prudential have outperformed fiscal year to date. I know we had MetWest in about 3 or 4 months ago, and their longer duration positioning certainly helped them outperform in the fourth quarter. They were up about 7.5% for the quarter. So it was good to see, given their positioning, how they performed in that type of market environment, which is what we would expect. Then finally, both UBS and PIMCO continued to do a nice job, and through the first 6 months of the fiscal year, total fund up 5.8%, outperforming the benchmark, and you can see the 5 and 7-year returns ahead of the benchmark and well ahead of the discount rate. Any questions on performance?
One of the things we used to do, I'm not saying we should change our policy. We used to, like, one of the things, we have non-lending in the fund, right? And one of the reasons is, I don't know if you remember, but we got burnt.
I think I do remember.
Right, back, what happened was somebody defaulted on one of the stocks. And then rates were so low that it didn't make sense. And I'm not saying we should or not.
That default was in the middle of the crisis, right?
Yeah.
Yeah.
And I don't know whether we think that we could do that or not do that, or whether we don't want to add that risk to the
For a
portfolio.
basis point or two.
Yeah,
What's,
It's not.
what do we, yeah, but there's one or
No,
two
I mean,
basis
it
points
wasn't,
maybe.
it was a reasonable amount of money. But
Well, it's
then,
gotten a lot tighter since
Yeah.
the GFC. So the structure around lending programs and the restrictions around lending programs have really honed in
You're not selling as many short options.
Yeah.
You're not selling so many options.
And the areas where you would do it, you know, are small cap US a little bit, maybe some international, but there's not a lot in the portfolio that is ripe for
Lendable,
security.
yeah.
lending.
You know, and I'm fine with not doing it. I mean,
Yeah.
I'm not recommending we do it at all.
Yeah, it's good to circle back and check it once in a while.
Yeah, and, can we go into, executive session?
I think we just need to request that, people to log off. Right,
Eileen and Dave, we wanna have a discussion, regarding, our contract with Empower, which
Okay.
it ends next year, right, 2025. But because we don't want whatever, if we have, we don't want our discussion to be on the internet so that they can understand what our thoughts are.
So we should log off, is that what you want us to do?
Well, I don't know, any other business?
I'm resuming back. Do you want me to?
Thank you. Is there a motion for adjournment?
There is.
And who is he? Could you identify yourself, please?
Richard Baskin makes a motion to adjourn.
I will second it.
All in favor?
Aye.
Aye.
Opposed? No. Thank you very much. Excellent.
Thank you.
Yeah.
I made a Valentine's promise to my wife that I'd be home by